You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
This is Bill Powers, and you are listening to Mining Stock Education. Thanks for tuning in, ladies and gentlemen. Well, in this episode, we are going to be touching base with Will Thomson. He is a fund manager with Massif Capital, and we've had Will on the show to discuss battery metals investing, and Will, in managing his fund, goes on several site tours, and a recent one that he's been on was actually at the California projects for Equinox Gold, which has been in the news, announced today a merger with Leagold. I want to get Will's thoughts on that, but Will, before we talk about that, welcome back to the show, and what are your thoughts in general regarding the billions of dollars of mergers and acquisitions that we've seen in the news of recent?
Thanks, Bill. Happy to sort of be back on the podcast with you. I think the billions of dollars that we've seen go into gold mergers is wholly appropriate for the industry. I think the statistic I always come back to is that it only takes about 4 companies in the iron ore space to cover or to produce about 50% of the iron ore every year. It takes about 10 companies to do the same thing in copper, and yet gold, you're looking at in excess of 25 companies before you hit 45% of global production. What that says to me, at least, is that there's plenty of room for consolidation. Now, the history of gold mining consolidation is not necessarily a great one, and so investors have obviously got to be careful, but I think that we've seen a bit of a trend, if you will, at least in our portfolio we have, of these at-the-market mergers. First, you had Barrick and Randgold. I know there's been one, maybe 2 others, and now, of course, we've had Equinox today. And the at-the-market mergers sort of have to be done if they make strategic sense for value creation. Otherwise, there's no point in doing them. And I think the management teams that have engaged in them thus far are fully aware of that. So we invested in Barrick last year ahead of the Randgold merger and have nothing but positive things to say about it. And I think that, with this Equinox merger, we've only just started to dig into it, but it looks, again, like a highly positive merger, and a lot of that value will be created because there is no premium to the market being taken, and it is occurring at the market. And so plenty of room for consolidation and some smart transactions that are happening.
Yeah, one of the things, we were both on the conference call this morning in which the management of both companies talked about why they're merging, and the new chairman of Equinox, if the companies this finalizes, Ross Beatty, talked about that there were real synergies. Some of the synergies are location with the projects and the mines being in Brazil. There's going to be an increase in quality management with the 2 teams coming together. And he did stress, like you said, investors hate these premium takeovers, and this seems to be a merger of equals that could benefit both. And he talked about that specific re-rating, that price to net asset value, that metric, that they should see a significant increase. What were some of your other takeaways from the call we just listened to?
Well, I think that there's certainly something to be said for the focus that they've got. It's diversified while remaining all in America, or the Americas, which I think is an interesting point. They seem to suggest that might be a risk reduction, or there's some risk reduction qualities to that. In that regard, I would disagree. I'm not sure that political risk in South America is necessarily any different than political risk in some places in Africa. I would go so far as to say maybe there are some places in South America where the political risk is much higher. I don't think Brazil is necessarily one of those locations, so they've got little to worry about there. Although I think Mexico is by no means an area of expertise for me, but definitely is for Ross. but it's got some funny politics at the moment. I think that Ross sort of made several points about the size, and I think that is quite important. And it actually goes back to sort of the discussion of the mergers and acquisitions in the space. So much of today's investing is done either on a passive basis or done via the sort of investment or retirement accounts of individuals, that a lot of investments need to size up and scale in order to be eligible to tolerate basically the flow of funds that can go into them. The minimum size for a lot of investments for, say, a large Vanguard portfolio or a BlackRock ETF, you need to be able to tolerate significant daily volume. And so the scaled up size of this new company, just purely from a flow of funds perspective, it will likely go higher on nothing more than that. And so I think that's quite positive. Some quite firm catalysts, I think one can expect next year, both on the operating perspective side of things, but also on the sort of technical trading side. So I know that when I was out there in California, the management team suggested that Equinox would probably be in the GDXJ come, say, February, I think, of next year. I don't remember the exact dates. But now, you're looking at probably the GDX and the Toronto Composite Index. So there'll definitely be some, sort of, if you will, almost forced buying. It's interesting to think of passive as forced buying, but definitely not value conscious buying, just buying. So, those are some interesting catalysts for investors. But over the next 2 years, say through to 2021, the production ramp up from Castle Mountain, squaring away Mesquite. You have potential Arizona underground. And then, of course, you have the Leagold assets, which we don't know as well, but have significant upside. It all looks like a very positive direction for the company to be going in. So
one of the things that was discussed and brought up by an analyst on the call was Leagold's possible unwinding of their gold hedging. When you're doing your due diligence on a gold producer, how closely do you look at what future production that they've hedged, and what are things that you do or don't want to see going on regarding a gold producer hedging?
Yeah, so I think that the new CEO, Neil, handled that question quite well, and he raised a sort of a good point, which was they put the hedges on specifically because they were engaging in a whole bunch of CapEx, and they wanted sort of foresight into what their cash flows were going to be, given that they were committing to these large expenditures. Now, generally speaking, my preference would be for companies not to be hedged on the gold side. But in that particular situation that he's describing, I think a degree of hedging makes sense. Going forward, this company, with the balance sheet that they're going to have, the cash that they're going to have, and the access to additional cash they hypothetically have if they, for some reason, need it, I would rather see the hedges come off. But as you sort of said, I haven't either looked into what the cost of taking them off is going to be, or how long or how far out they've hedged their gold production. So I think, given that they're already on the books, it's going to have to be a sort of game time call based on what the economics of actually unwinding them looks like. So no point in taking a big hit, if you will, if the value isn't really there in unwinding them. So it sort of depends on where they've hedged the gold price at, I think.
On their balance sheet, as they presented it on the call, they said they'll have $270 million cash, $550 million drawn debt. So the net debt is going to be $280 million. And with the production profile of the combined company, I mean, are you comfortable with a debt like that and a balance sheet like that?
Yeah, no, I think it's a pretty strong balance sheet for a gold producer, especially given, sort of we did some quick back of the envelope math, and if you told me that next year they did something in the realm of 200 million in free cash flow, let's be conservative and say it's 175 million maybe, I would say that seems perfectly feasible. And given that type of free cash flow profile with, sort of it going up again in 2021, I think we're looking at at the very least 2 years of big free cash flow jumps here. That debt is eminently manageable. I would go so far as to say, not that I want them to, but I'd go so far as to say they could handle more. Obviously, my preference would be that they not take on debt they don't need to, but I think it's a perfectly sound balance sheet.
And it's hard not to like Ross Beatty. He invests US $40 million at the current market price as part of this transaction, isn't it?
Yeah, no, I mean, you cannot complain. Having gotten to know the management team a little bit, I don't know Ross, but the rest of the Equinox management team I've gotten to know a little bit. They are all invested, all the way from, Chris, who is the CEO, to a bunch of the geologists. They are heavily exposed to the company. Their interests are well aligned with ours. And again, Ross, putting in money right here at this price, I've got to think he thinks this is at least a double or something from here. Not that that's necessarily our valuation, but he's got to think that there's quite a bit of value that can be squeezed out if he's putting in 40 million here.
And I think he indicated that with his statement about there should be a re-rating just based on what he referred to as de-risking, and then that price to net asset value with the bigger company.
Yeah, I mean, I think Neil said something in the realm of, if it re-rates to what other comparable companies on a production profile look like, you're talking about a $2 billion US valuation, whereas I believe right now it's about a 1.3 billion US valuation. So that there's substantial upside there just right off the bat from that hypothetical revaluation. And I don't think they'll necessarily get all of that, but they'll certainly get quite a bit of it.
A couple weeks ago, you were in California where Equinox has two of their projects, Mesquite and Castle Mountain. Can you kind of walk us through your firsthand knowledge of these projects and let us know what you think?
Yeah, sure, absolutely. So I think went out to California. It was a great trip. First site we visited was Mesquite. Mesquite is obviously sort of up and running. Legacy asset. I think of the two, it is definitely sort of the less value additive asset, but there was some sort of positive updates. I think the most important one being that they've gone ahead and looked at several historic waste dumps from when it was previously in operation, and have found that the waste dumps are averaging about 0.35 grams per ton versus the reserves that are 0.57 grams per ton. And so they sort of expect now that the waste dumps, which, sort of there was no value for, if you will, either in the resource estimate or in the acquisition price, are going to add somewhere between, we'll call it a 6 months to a year of mine life, and reduce the sort of stripping by blending it in with whatever they pull out of the several pits that they're currently operating. So I think that that's a very sort of positive takeaway. I will say that they seem to have had some struggles at Mesquite in terms of getting the operations flowing correctly. It's a low grade deposit, and so they've got to move a lot of ore and a lot of waste. But they're certainly making a lot of progress, and it was quite interesting. they spent a lot of time talking about how many times the Mesquite asset has changed hands and how much data was lost in that process and how much time they've had to spend now sort of trying to understand the geology. And it, in some regards, was an operating mine that had no geological model to go along with it. And so I think that this past year, what you've seen is them trying to run the mine and understand what they had on their hands at the same time. And next year and going forward after that for a couple of years, you're going to see them operating a mine that they have a geological model for, that they feel comfortable with, and that they're going to be able to sort of sequence production from in as efficient a way as possible. So I would expect the sort of value add from the mine to increase going forward from what it was this past year. In regards to Castle Mountain, it's all on track. Everything's moving in the right direction. Given that both mines are in California, permitting and sort of issues like that are obviously of great concern. But in the case of both mines, they seem to have a good grasp of what California expects of them, and the hurdles that they need to overcome. I think the sort of critical issue for Castle Mountain is going to be permitting in regards to water usage. And in that regards, they seem to have been quite thoughtful about it. And the management team has squared away I think it's about 3 different options for sourcing water, not all of which involve the same regulatory authorities. And so if they lose out on any single one sort of approach to sourcing water, they have some backups. And so I think that thought process, which they've also done sort of in regards to the footprint for phase 2 of Castle Mountain, of this sort of, we are prepared to go into the permitting process this way, but if we need to pivot, we've already got a secondary approach lined up. And in some cases, like the water, let's say a third sort of approach lined up, is appropriate for a place like California where, one can sort of never be sure necessarily of what direction the state wants to take its regulations in.
I talked to Christian at the SPRA conference this last summer, and I asked him that question about California as a jurisdiction. I said, it's one of the most far left politically states in the union. And then he shared with me that may be the case, but in these more rural areas, not so, and they do appreciate what the mine can bring to the local economy. Did you see any anecdotal things you can share, or in your own due diligence, would you agree with that?
So I guess what I would say is, in driving to the mines, I will say that these mines are in the middle of nowhere for all intents and purposes. So there is nothing around them for, other than very small towns. I'd say, sort of draw a circle with a diameter, sort of 6 hours of driving, if you will, with the mine sitting in the middle. So there's really nothing around them. In regards to some place like Castle Mountain is in which county? I forget which county exactly it's in California, but whichever county it's in has one of the highest unemployment rates in the country. And a lot of the population is either engaged in some sort of natural resources or unemployed, basically. So they're either farming, working at Castle Mountain, which isn't that many people at the moment, or they're unemployed. There's really not much else going on. The farming in the area is frankly quite remarkable because it's all desert. So they divert the Colorado River down, and it's pretty remarkable what they're able to grow there. But I would say, just based on those sort of stats, one would think that these projects and the employment that comes with them and the potential for expansion are looked at favorably. Now, in regards to Castle Mountain, it was run and shut down in a very sort of efficient and effective way. And so the state of California actually uses Castle Mountain as an example of how to reclaim a site once a mine is shut down. Now, of course, they're going to have to sort of reverse that because they're putting it back into production. But so the local community around Castle Mountain, at least according to management and according to the sort of regulators' take on it, is all quite favorable and positive on Castle Mountain, in part because not only was it mined well in the first place, but when it was shut down in a very clean and efficient way. So, those points are what they are. They aren't necessarily the basis for an investment thesis on their own, but it seems like the areas are positive and favorable for mining.
Equinox has said that they want to achieve production next year in 2020. Phase 1, which would be years 1 through 3, is 45,000 gold ounces a year. And then they want to ramp up to phase 2 in years 14 through 16 to 200,000 ounces of gold a year. Based on what you saw in your analysis of the company, do you feel like this is a reasonable goal that they could achieve?
I don't see why not. The only potential delays there don't appear to be any geological issues. There don't appear to be any funding issues, especially now. The only issues that could crop up appear to be permitting. And again, once they get their phase 1 permitting squared away, they've designed phase 2 such that it fits in the same mine footprint, if you will, permitted footprint as phase 1. And so the new permitting that needs to occur in order to put phase 2 into production in year 4 is much more limited than what they'd have to go through if they actually had to expand the permitted area for the mine from phase 1. So that's, again, just an example of them thinking through the permitting process in this, sort of difficult location. And I don't see any reason why, what they say they'd like to do, they can't accomplish. There don't appear to be any hurdles, if you will, that they haven't at least contemplated. I'm sure something will come up, as it always does, but sort of the big picture items, they appear to have thought through sort of quite deliberately.
Will, do you hold Equinox in your fund currently? And as a result of this merger and your site tour, if you do hold it, will you be adding to your position?
So we do hold it in our portfolio. We've held it since earlier this year at some point. I don't remember when. I'd probably call it February or March. We will not be adding to it only because we had already taken it to a full position size and sort of don't add to things once they've reached a full position size and then have appreciated further, if you will. So I would add to it here if that wasn't the case, but it sort of is what it is, and it's how we manage our portfolio.
And is it one of the larger gold producer positions you have in your fund?
Yes. Equinox is one of the larger. We have 3 gold positions, and they're actually all roughly the same size, but it is one of the larger of the 3.
So then do you prefer that kind of emerging mid-tier where you get that re-rating rather than just going with the barracks, the big boys?
So when we manage our portfolio, especially for something like gold, which we sort of regularly and always have in the portfolio to a certain degree, we think about having a mixture of what we consider to be ballast positions, asymmetric return positions, and then something that sort of fits in the middle between the two. And so a ballast position would be something like a barrack, which we have in the portfolio. Equinox is something between an asymmetric return and a ballast position. And so we like to have something like that in the portfolio at all times, in addition to a ballast and, say, an asymmetric. And at the present time, our asymmetric sort of return position was Continental Gold, which we held since earlier this year and which is also getting taken out now. So by a Chinese producer.
So that was a win for you.
That was a win for us this year, yes.
Excellent. So your website is Massif Cap. That's Massif as in Frank, cap.com. Anything else the listeners should know about what Massif Cap is up to as we conclude?
Feel free to go to the website, sign up for our research and letters, and we'll have our fourth quarter letter out. Probably about 4 weeks, and we'll talk about the gold stuff. We'll talk about our interest in energy at the moment, which as a percentage of the portfolio is rapidly expanding. And we think there's a lot of good opportunity in the energy space right now. And I'll have to see what else we touch on. But we distribute research and white papers, and people seem to enjoy reading them. So if you're interested in natural resources, please sign up.
Well, Will, as always, thank you for coming on Mining Stock Education and sharing your insights. I appreciate it.
Thanks, Bill.